Welcome to the Deep Dive. Today we're digging into the Dubai Real Estate Property Monitor Report for October 2025.
Yep.
And the whole mission here is to understand this shift in the market. It's gone from just white-hot expansion to what the report calls a well-deserved breath.
Which I think is a great way to put it, because what's so fascinating is that the headline figures, they might suggest things are easing off, but the context, it just screams strength.
Okay, so it's normalization.
Exactly. It's much healthier than just constant, acceleration.
All right, so let's unpack that. The cooling pace. We've got the dynamic price index, the DPI, and it saw an increase of just 0.13% month on month.
Barely a nudge.
Right. It feels like a very gentle deceleration, especially compared to what we saw in late summer.
And for you listening, that DPI is so important because it's not just tracking the sale price, it tracks the rate of change. So this tiny movement, it confirms momentum is shifting from, let's call it explosive growth, to more of a sustainable cruising speed.
And cruising at a pretty high altitude, too. The average property price is now AED 1,683 per square foot.
Mm-hmm.
If we connect that to the bigger picture, that figure is more than double the level we saw back in the October 2020 trough.
And crucially, it's well above the old 2014 peak. So that upward trajectory, it's completely intact.
Absolutely.
And before we get to volume, just to put some real numbers on that for you, that price point means apartments are averaging about AED 1.26 million.
Okay.
Townhouses are at AED 3.18 million, and then villas are holding that premium spot at AED 9.59 million.
Let's talk transactions then. October clocked in 19,760 sales. Now, that is a 4.9% dip year on year.
It is.
The report says this is all because October 2024 was the highest month ever. But does that comparison maybe mask some underlying weakness, like are high interest rates finally hitting the buyer pool?
That's the critical question, but the data really pushes back on that idea.
Also.
Because this October is still the second strongest October on record. And maybe more importantly, if you look year to date, transaction volumes have already hit 98% of last year's full total.
Wow. So momentum isn't the problem.
Not at all. Ceiling is just incredibly high.
And the real insight here, I think, is where this volume is coming from. The market is it's so dominated by off-plan sales.
It's a massive share, 70.6%.
So what does that tell you?
That percentage is the key. It tells us this market is being driven by developer confidence and this expectation of future population growth. They introduced over 14,000 residential units in October alone.
So they're betting big on the future.
A huge bet. They're meeting current demand and planning for future market depth all at once.
Okay, let's switch gears to the part that really screamed confidence to me.
Yeah.
Financing. Mortgage activity just rebounded so sharply.
A huge spike, yeah. A 28.9% month-on-month increase.
What's behind that?
That jump is basically institutional capital signaling risk on. That recent 25 basis point interest rate cut.
Oh, yeah.
It wasn't the number itself, it was the psychology.
The signal it sent.
Exactly. It was the trigger professional buyers needed. It told them the market is stable, so they moved all that deferred capital back in to finance big portfolio buys.
And I'm guessing those acquisitions skew towards luxury. The mid-tier, that $1 to $3 million Durham bracket, is still the biggest segment.
It is over 50%.
But the high-end tier, so properties over $3 million, saw the strongest growth in market share, was up 2.6% month on month.
It's a dual market phenomenon, really. The mid-tier is being propped up by great job creation, but that luxury tier, it's driven by that constant flow of high net worth individuals looking for stability and, those high quality new launches.
So if we tie all this together, the big story is a shift. We're moving from that rapid, almost explosive growth to a more sustainable, elevated trajectory.
Right.
The fundamentals, they're still exceptionally strong thanks to population growth and economic resilience. Price growth should stay positive, just moderated.
The market is settling in. It's trading some of that crazy velocity for long-term health, longevity.
So let's end with a final thought for you to chew on. We've learned that over 131,500 residential units have been launched just this year. That supply volume is way, way beyond typical levels.
Mm-hmm.
Now, this huge new supply is currently balancing out sales, which is what's moderating that price growth.
Mm.
So the question is this: given the massive increase in inventory and the dominance of off-plan, what does next year actually look like for delivery? And how will all this future supply hit absorption rates across the different price segments? It's a huge inventory puzzle that's really going to define the market's stability going forward.